It began not with a crash, but with a quiet imbalance. A drift, subtle, so slight that those inside the system barely noticed. Prices crept, debt swelled, trust thinned. The world did not wake to a collapse. It woke to a shortage of the thing that made the global order run: liquidity, credit, dollars in circulation. Not chaos, a tightening, a squeeze. A moment when the system's most essential lubricant began to evaporate. In the winter of 2025, central banks spoke in measured tones. Governments reiterated stability. Markets shuffled higher. Yet behind every reassuring statement, a deeper truth gathered force. Behind every calm quarterly report, balance sheets told a different story. Credit drying up, reserves dwindling, dollar funding strains surfacing in corners of the financial system once thought robust. The narrative was subtle, not dramatic, but the mechanics were unmistakable to those who study history, not as a series of isolated crashes, but as patterns, rhythms of expansion and contraction that repeat when incentives align and imbalances deepen. Long before headlines, there were signs. The so-called dollar shortage was not a surprise. It was a consequence, a structural consequence, of decades of global finance built on debt, leverage, and the United States' role as the provider of last resort currency. Across continents, corporations, banks, even sovereign treasuries had come to depend on dollar funding lines. When demand outpaced supply, not because of panic, but because of structural overextension, the strain appeared as a shortage, not a crash, a mismatch, a bottleneck. This moment did not erupt. It germinated. In shadow, banking systems, in foreign exchange markets, in the creeping inability of borrowers to roll over short-term obligations. In rising interest, costs that consumed cash flows faster than earnings could cover. On the surface, credit markets looked calm, but beneath lay fraying links, extended duration, concentrated exposures, thin liquidity. People felt it first in credit spreads, then in funding costs, then in the stubborn refusal of liquidity to fill gaps central banks once smoothed without hesitation. The situation was not that the world lacked dollars. It was that the plumbing that moved dollars around the world was clogged. The world discovered that currency shortages can emerge well before a crisis becomes headline news. And when they do, they behave like slow-moving ruptures, leaking confidence, tightening credit, constraining trade, and forcing a reckoning with dependence on a single hegemonic currency. This pattern had unfolded before, many times, not identically, never in exactly the same form, but with a familiar trajectory: dominance, overextension, strain, structural imbalance, tightening flows. And yet, each generation convinced itself, with the benefit of complex financial engineering and new instruments, that this time was different, that liquidity could be manufactured, imported, or coaxed into existence with sufficient resolve. The world now stands inside that pattern again, not at the moment of collapse, but at the moment when scarcity begins to shape choices, when actors who once assumed abundance must adjust to constraint, when the invisible architecture of global finance betrays its fragility, not with a bang, but with the growing realization that dollars, not fear, are becoming scarce where they matter most. This is not a crisis in headlines. This is a crisis in balance sheets. It is happening as you watch. And the historical arc, once set in motion, is neither random nor avoidable. Dominance, overextension, collapse. It is a rhythm older than any individual economy. The story repeats in layers. First, a nation rises to provide the world's preferred currency. Its balance sheets grow. Its credit spreads widen to every corner of global commerce. Other nations, other markets align their own financial structures around that currency. Confidence becomes systemic. Dependence becomes structural. Then, expansion reaches its limits. Debt accumulates faster than productive capacity. Obligations compound. The issuing nation still appears stable. GDP grows. Markets rally. Public perception, the perception of stability, lags the reality of structural strain. Meanwhile, the system's mechanics, the flows of credit, the availability of short-term liquidity, the trust in the currency as collateral, begin to stretch. They are elastic, but not infinitely. Next comes the stage most overlooked, the denial phase. Analysts and policymakers assure the public, often accurately describing the short-term indicators, yet missing the underlying pattern. Liquidity, they argue, is ample. The world has resources. Central banks can intervene. But this stage is not a failure of competence. It is a natural consequence of the system's incentives. Everyone, from sovereign treasuries to multinational banks, is motivated to preserve the status quo, to assume that history will bend differently in their hands. Finally, strain accumulates silently, not in a single headline event, but across multiple instruments, markets, and regions. Short-term dollar funding begins to tighten. Corporations delay payments, banks raise internal lending rates. Derivative markets reflect rising counterparty risk. The system's vulnerabilities are exposed not through a single trigger, but through the compounding friction of interdependent obligations. This sequence, dominance, overextension, denial, structural strain, is the pattern. It is neither unique nor speculative. It is observable. It is measurable. And it explains why modern analysts speak less of crashes and more of shortages. Because the early signs of systemic stress do not appear as dramatic falls in equities. They appear as subtle, persistent mismatches in liquidity, a shortage of dollars where they are most essential. History demonstrates that the stage preceding collapse is deceptively calm. The currency in question remains widely accepted. Markets may even rally. The perception of stability masks the deepening tension. By the time scarcity is widely acknowledged, the system is already adjusting under stress, often in ways that are abrupt, costly, and unavoidable. What defines this pattern is not the size of the nation or the number of banks. It is the architecture of dependence. It is the accumulation of obligations denominated in a single dominant currency. It is the inevitability that, once scarcity appears, the system's participants cannot instantly adapt. They can hedge, they can ration, they can negotiate. But the pattern, once set in motion, progresses according to its own logic. In other words, the world is not teetering on the edge of chaos because of panic. It is teetering because of structure. The shortage is mathematical, procedural, and predictable. The consequences are already embedded in the system. History shows that recognition of the problem always lags behind its onset. And when the world finally confronts that lag, the adjustment is swift and uncompromising. This framework of collapse, repeated across eras, is not theory, it is pattern. And to understand the present, we must examine the past. The first historical instance of this dynamic unfolded with the British Empire in the 19th century. By the mid-19th century, the pound sterling had become the world's dominant currency. London was the hub of global trade, finance, and maritime power. British banks provided credit to markets from India to South America. The empire's debt instruments were accepted everywhere. Confidence in the pound was nearly universal, anchored in the credibility of the Bank of England and Britain's naval supremacy. At first, this dominance brought enormous structural advantages. British merchants could borrow cheaply. Governments could finance wars and infrastructure projects without severe constraints. Global trade expanded rapidly, facilitated by the ready availability of sterling credit. Other nations, eager to participate in this network, aligned their own financial systems around the pound. Exchange rates were stabilized, debts were denominated in sterling, and liquidity flowed outward from London in seemingly endless streams. But expansion carried costs that were invisible in the early stages. The British economy began to accumulate obligations faster than productive capacity could sustain. The empire relied increasingly on foreign borrowing to fund domestic and overseas projects. Commercial banks extended credit with minimal oversight, confident that London's status as a financial centre provided implicit security. By the 1870s, the system was heavily leveraged. Interest obligations were rising, yet returns from colonies and investments were often delayed or inconsistent. Structural strain appeared first in subtle ways. Short-term funding markets began to tighten during periods of international stress. Banks raised rates for foreign borrowers. Central authorities intervened with liquidity, but only temporarily. Credit spreads widened, signaling that risk was accumulating. Yet public perception remained optimistic. Newspapers praised Britain's industrial and financial leadership. Analysts insisted that new financial instruments and expanding markets would prevent systemic failure. The narrative was, "This time is different," even as the data suggested otherwise. Denial persisted until the early 1880s, when the pattern could no longer be ignored. A series of financial shocks in Argentina, Egypt, and India tested London's ability to supply liquidity. Banks hesitated to roll over loans. Short-term credit lines for foreign merchants dried up. The empire faced a mismatch. Sterling reserves remained substantial, but the plumbing that moved pounds globally was strained. Trade slowed, borrowing costs spiked, and some markets froze entirely. The world was still using sterling, but dollars, or pounds in this case, were no longer reliably available where they were needed most. The British example illustrates a critical point. The system's collapse was not caused by war or revolution, nor by a sudden loss of confidence in London. It was caused by structural overextension and the accumulation of obligations denominated in the dominant currency. Scarcity arrived slowly, invisibly, and inevitably. The mechanisms that had once allowed Britain to supply global liquidity became insufficient. Shortages appeared first in timing and accessibility, long before prices collapsed or markets panicked. This pattern, structural overreach, liquidity mismatch, denial, and eventual adjustment, would echo a century later. Across the Atlantic, a new hegemon was preparing to assume the same global role. By the early 20th century, the United States had emerged as an industrial powerhouse. Its economy was larger, its markets deeper, and its financial system more complex than Britain's had ever been. The dollar began its ascent as a reserve currency during World War I, consolidating further in the interwar years. By the post-World War II era, it had assumed the mantle of global dominance, supported by the Bretton Woods system and the creation of institutions designed to stabilize international trade. Yet the structural dynamics were remarkably familiar. Dependence on a single currency, the accumulation of debt, and the expansion of credit beyond sustainable limits created vulnerabilities. In the 1970s, as the US budget and trade deficits swelled, foreign central banks began to hoard dollars. The system teetered, not because of an immediate crisis, but because the underlying architecture could no longer support unrestricted liquidity. The parallels are unmistakable. Dominance brings structural advantage, but overextension carries hidden costs. Denial prolongs stability, even as risk accumulates. Scarcity precedes collapse. And when the system finally adjusts, it does so abruptly. The next stage of this story brings us closer to our current moment, the modern parallel where dollars are scarce, not because of panic, but because of structural dependence. Today, the global financial system mirrors these historical patterns with striking fidelity. The dollar remains the world's dominant currency. Nearly every major commodity, every cross-border loan, every international settlement still runs through the US financial system. Corporations, sovereign treasuries, and central banks alike rely on short-term dollar funding to meet obligations that, on paper, seem routine. The mechanics are subtle. A European bank may need overnight dollars to settle a trade. A corporation in Asia may rely on a US dollar-denominated credit line to finance operations. A central bank may intervene in foreign exchange markets to stabilize its own currency against the dollar. These flows are typically invisible to the general public. They operate like the arteries of the global economy, moving liquidity precisely where it is needed. But the arteries are constricted. US debt has reached historically high levels, and borrowing costs for short-term obligations have risen. Leverage remains elevated in both the corporate and shadow banking sectors. Central banks, though willing to provide support, face limits on how much liquidity they can inject without undermining their own credibility. Foreign holders of dollar reserves have begun to diversify, reducing their reliance on US assets and seeking alternatives in other currencies or gold. This is the modern dollar shortage, not a crash, not a sudden panic. A mismatch between the demand for dollars and the ability of the system to supply them seamlessly. It appears first in funding markets, spreads widen, repo rates spike, and banks hoard liquidity rather than lend it freely. Then, it ripples outward, affecting trade financing, corporate cash management, and international settlements. History shows that this stage can persist deceptively long. The system appears stable, markets function, headlines remain calm, confidence remains high. Yet beneath the surface, the system is adjusting, rationing dollars, prioritizing liquidity, and testing the limits of structural resilience. The danger is not in volatility, but in scarcity itself. A shortage of dollars forces actors to make choices they did not previously have to consider. Corporations delay payments. Banks prioritize domestic over international lending. Sovereign treasuries adjust foreign exchange policies. Every participant recalibrates, not out of fear, but out of necessity. This stage mirrors the late periods of historical hegemonic currencies. Britain in the 19th century, the US in the 1970s. In both cases, scarcity appeared first in timing and availability, not in market prices. The system's dependence on a single dominant currency magnified every mismatch. And the same is happening today across continents, sectors, and institutions. The modern parallel is undeniable. The world still functions, dollars still circulate, but every participant now faces structural limits. The plumbing of global finance has no infinite capacity, and when scarcity collides with obligations, the system adjusts with relentless efficiency. Next comes the stage where stability appears strongest, the acceleration phase, before sudden deterioration becomes unavoidable. This is the paradox of late-stage systems. They appear strongest just before they falter. Credit markets hum, trade flows continue, stock indices hold firm. On the surface, nothing seems amiss, yet beneath that calm lies a web of stretched obligations, leveraged positions, and contingent claims that can no longer be guaranteed. Liquidity appears abundant because central banks and large institutions intervene to smooth minor disruptions. Yet these interventions mask the accumulation of strain rather than eliminate it. Each temporary fix allows the system to operate a little longer, to push deadlines forward, and to create the illusion of stability. The longer it persists, the more participants assume the system is resilient, and the more dependent they become on a currency whose supply is increasingly constrained. During this acceleration phase, mismatches grow exponentially. Corporations borrow to cover previous obligations. Banks extend credit to maintain client confidence. Governments issue debt to finance deficits. Every participant acts rationally within the incentives of the system, yet their collective actions magnify structural risk. The scarcity of dollars is not noticed in daily operations because short-term solutions temporarily bridge gaps. Historical patterns confirm this behavior. Britain in the late 19th century or the US in the 1970s experienced long periods where markets appeared healthy, liquidity seemed sufficient, and optimism dominated commentary. Yet during that time, the underlying imbalances were accelerating. When shortages became critical, adjustments were abrupt, costly, and unavoidable. Today, the dollar shortage functions the same way. Funding pressures may rise gradually, but when they reach critical nodes, interbank lending, cross-border settlements, or short-term repo markets, stress can propagate swiftly. The acceleration phase is not a sign of strength. It is the system's final period of apparent stability before scarcity forces structural recalibration. Participants often misinterpret this calm as reassurance. They reduce caution. They leverage further. They assume that central banks will always intervene, and in doing so, they deepen dependence on a currency whose capacity to supply liquidity is finite. This stage is crucial because it explains why warning signs can be ignored for months, even years. The system functions under strain, masking the reality of scarcity. When the tipping point arrives, the adjustments happen rapidly, even violently. But the origins of the stress were entirely predictable. In essence, the acceleration phase is the quiet countdown. The system appears strongest, but every signal beneath the surface points to structural limits. And once scarcity meets obligation, the pattern of collapse, familiar to historians, completes itself with an efficiency that is both inevitable and indifferent to perception. The final act is not panic. It is the system realigning itself with the constraints it has ignored for decades. Cycles repeat because human behavior rarely changes. Incentives remain constant. Borrow when cheap, expand when confident, assume stability will continue. Authority figures assure the public, even as structural risks grow, markets adjust, but only when forced. The pattern has repeated across centuries. Dominance, overextension, denial, strain, and eventual recalibration. Each cycle leaves its mark. Some nations lose global influence, some industries collapse, some individuals pay the cost in lost savings or failed enterprises. Yet the structural lessons are often ignored because the early stages of strain appear invisible to those inside the system. Scarcity is subtle, collapse is sudden, history is indifferent. The dollar shortage today is not a failure of policy or morality. It is the outcome of a system designed for expansion, optimized for liquidity in normal conditions, and highly sensitive to overextension. Dependence on a single currency, combined with high leverage and global obligations, creates predictable scarcity long before a crisis is evident in headlines. Understanding these cycles allows perspective. Observers can recognize when scarcity is structural rather than emotional. They can see that adjustments, though disruptive, follow a logic that is measurable and observable. The pattern is not new, and the lessons are embedded in history. Recognizing them does not prevent change, but it frames expectations and clarifies incentives. What defines these moments is not panic, but inevitability. Markets do not fail because participants are irrational. They adjust because structural limits force them to. Currency shortages, funding constraints, and tightening credit are the system's language for realignment. Those who study the pattern can read it as a signal, not a warning. Ultimately, the lesson is simple yet profound. Systems expand until their architecture can no longer sustain obligations. Scarcity appears before collapse. Stability is deceptive before adjustment. Human behavior repeats, incentives remain aligned toward expansion, and the mathematics of leverage do not lie. If you're watching for the first time, welcome to the Economy Club. This is where we study the forces that shape history and the patterns that quietly decide the future. Stay curious, stay grounded, and we'll see you in the next cycle. The answers aren't hiding in the future. They're written in the past, and now you know where to look.